Hi traders, and welcome back with another video. In this video we're going to cover another one of Wyckoff laws, which is supply and demand. Now, I'm not going to go into too much depth, as essentially a supply or demand zone is the same as a POI or an order block, and we already have education around that. In this video, I'm just going to explain how we can look at it in a little bit of a different way, as opposed to just refining our order blocks to one chosen candle. So essentially, supply and demand has been around for years and years and used in stock markets, commodities, and all different types of instruments and all that sort of kind of stuff. And essentially, when the demand for that currency is greater than the supply, then prices go higher. And when the supply is greater than demand, prices fall lower. And by understanding how to mark these zones, we can use them as reaction points because essentially it's a battle between buyers and sellers. And by understanding these areas of supply and demand, we're able to understand what the tone of the market is. Are we in a seller's market? So, should we be looking for shorts? And again, these are reaction points. They're not always gonna hold. Sometimes they're gonna fail. And that's what a flip essentially is called, is where we've seen an area of demand get completely smashed through and we sometimes see that come back and retest and it turns into an area of supply. Now, by seeing these areas of supply and demand fail, we're able to look at the tone of the market changing from a market of demand and a market of supply. Now, essentially, premium discount comes into this. So, we need to understand that. You've got to understand that price when we're in a supply market is usually going to come back and revisit a premium range. A premium area of pricing past the equilibrium to seek a better price, a premium price for sellers to get involved. So, it's important to understand that when we are marking up our 15-minute POI, we look for our POI in premium or discount, as that is where you're going to get the better returns. You're going to get your higher probable entries as market seeks these areas across all time frames. So, using the 4-hour and the 15-minute, I find the best to understand price action better, and areas of supply and demand and POI are respected in these premium discount areas. They're sort of my golden time frame. So, once I've looked at order flow in the morning, and I've looked at what the 4-hour direction is telling me, I looked at what the 15-minute is telling me, I look at order flow, what my expectation of the next possible move is, and then mark my supply and demand zones. What I'm looking at for the day, understanding that we have 4-hour POI, they work very well. It's a golden time frame for me. We see really nice reactions from there for potential higher time frame continuations or even reversals. And also, the 15-minute, as we see 15-minute mitigations of supply and demand zones quite a lot during the day. And also, looking at the 5-minute, if we have come out of a 15-minute or a high time POI, or area of supply and demand, we're able to then wait for further confirmation. See a 5-minute break of structure, a new 5-minute area of demand or supply created, and then we look for a lower time frame shift from that newly created 5-minute order block. That's just been a bit more conservative. I prefer that over risk entries. It's essentially a confirmation within a confirmation. Essentially what we need to understand is when we are looking for 15-minute supply and demand zones, or for our order blocks, whatever you want to call it, it also essentially means the same thing. If we see a range like so, and then we see a breaker structure, this would normally be our POI. Now with a supply and demand zone, we can essentially wait for price to mitigate this whole area, and you'll usually find that price seeks the equilibrium of any given range that breaks structure. So using these areas, we don't have to refine it to one single order block, as you can see here. The reason why I've started with some examples and trades is to show you how we're able to identify these. So, this is a higher time frame 4-hour, bearish order block. Now, if we look at structure here, this is our 4-hour order block. We break structure, we create an area of demand. So, at some point in its life, this area is more than likely to be revisited, as we know. So, we've seen an impulsive breaker structure. We've seen an impulsive break of high time frame structure. So this area is more than likely going to be respected as we see causes being built to support the mitigation. We have equal lows here. We have equal lows here. We're creating cause for the effect for higher prices. So, if we look at 15-minute structure, we have a breaker structure here, which creates a range and a break structure. We see liquidity printed. We see a mitigation. Now, this is why we don't take risk entries from 15-minute POI. As you can see, we've swept some liquidity and we've had an imbalance fill. Okay, but if you look here, this is the 15-minute time frame. So how many opportunities do you think we'd be able to get involved in with continuation entries towards this area of supply? A lot. Now we can see that by push-pull price is creating new lower time frame areas of demand on the way up. Now you can see here, we had a break of structure create a high. We then failed to make a new high, which is our mitigation. We broke swing structure, creating a new area of supply. We've seen 1, 2, 3 touches. Sometimes we'll see that. You'll see multiple retests, almost like a supply and demand zone. Now we're able to use our low time frame confirmations and trend shifts, and all the other concepts that we look at to understand of where the liquidity is going to be ran, or we're able to catch some short-term moves. Now, as you can see, we have printed liquidity, as we've seen in mitigation away from this area of supply, which is a cause for higher prices in the future. Now again, this area has been mitigated again, creating more liquidity to support this higher time frame bull mitigation. So, we can get involved in longs. From here, we've got an area of supply here where we can get involved in shorts. We come back and mitigate this area. As you can see, we started to break structure coming down, so there would have been opportunities to go long. Now we're also printing higher low. We're creating costs for lower prices, so we've got motive for bearish prices. Now, again, we've got an area of demand here. We break structure. We have a range. This is why you're able to hedge. Now, this is the 15-minute. Obviously, I don't take 15-minute risk entries. But again, structure is structure. I've seen a lower time frame trend shift. We've seen some liquidity built down. You can get involved in a trade. Now, this is a risk entry in the 15-minute, still providing a 1 to 14 return. So, we know that price is likely to go back to here. We see the cause. The effect is bearish prices. So essentially, this is an area of demand. We break structure, we range, we see mitigation and continuation. Then we see this area fail. So, this is telling us that we're likely to see sellers step into the market. So, what we essentially see now is a fresh area of supply created. This area here. We break significant structure here. We did break this structure, and this structure, and we've got cause for the mitigation. So again, just looking at pure risk entries, we could have bought from here and got involved in continuation entries in the lower time frames, and we can sell from here. Now, these supply-demand zones are changing all the time, and we can see that whether they're being respected and whether they're not being respected, they're being completely smashed through. So, these reaction points from 4-hour POI or 15-minute POI, you're going to be able to build your trade ideas based on that reaction as long as it meets your criteria. Essentially, we've broken swing structure, creating a new lower low, and we've got a lower high. We see a range breaker structure, motive for mitigation, motive for lower prices, and we just continue with the flow of the market. So again, I didn't want to go into too much depth as it's actually quite a simple concept to understand, and that's something that I trading supply-demand a long time ago before I came into the finer details of smart money and wick-off and lower time frame executions. But essentially the key things to remember is we either see an impulsive move away from a range or an area that breaks significant substructure or swing structure, and then we look for cause for that mitigation. And then what we see is we can have a trade towards it, as we know that we can follow that high time frame liquidity, or we wait for the reaction and trade the reaction. Now, whether that is with the trend or with following a trend order flow, we can trade these reactions, and normally we can comfortably still get 5-10R before price reverses, if that's what price decides to do. We never know what's going to happen in the market. We can use our concepts, we can understand cause and effect in the liquidity and inefficiency and supply and demand, and we can have a good idea of price direction, but essentially the market will do what it wants to do. And all we can do is put all these concepts together to give us a high probability setup. So, understanding, we look for a range and a breaker structure, which creates an order block or a POI or a supply and demand zone. We look at the bigger picture. Mark your 15-minute expectation order flow to understand what is happening, because the 15-minute time frame is going to be one of your golden time frames. So, I want you to spend some time looking at structure, zooming out, understanding what is happening. Lower low, lower high, lower low. We're in a bearish market, so we want to be shorting from these areas. And if we get an opportunity to hedge back into our area of supply, then fantastic. So again, go through study looking at areas where we have seen a breaker structure, we've seen a range, and we've come back and we've mitigated it and it's been respected. Whether that's high time frame or lower time frame, you're going to see these areas of supply and demand all over the market. Cause buyers and sellers are continually battling. Whether you are a retail trader or you are a big player, there's lots of different people taking different positions for a concoction of different reasons, and we just need to trade the reaction on what we see. So, I hope that's helped understand it a little bit more. Maybe start with some clean charts. Go through some naked 15-minute charting and just plot these areas and look to potentially where prices reacted from. And maybe drop down to lower time frames and see if you can get that lower time frame momentum shift and you see where we could potentially build our trade ideas to fuel that next leg, whether that be to create a higher high or to create a higher low or whatever. Understanding order flow is going to give you that bias, that direct. So I hope it's helped. I hope you've enjoyed the video. Just drop a comment if you have any questions around it, and I'll catch you in the next video.